Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here alongside Scarlet Fu. And we're counting you down to the closing bell and here to help take us beyond the bell. It's our global simulcast. We're joined right now by Tim Stenovec, Katie Greifeld in for Carol Massar today. We welcome our audiences across Bloomberg Television, radio, as well as on YouTube. And quick take here. Interesting day in the markets, Tim, where I think the market kind of looking for direction here. Not quite sure they're going to find it here on a week like this.
Yeah, the only thing that I'm seeing is tech really underperforming today, and we're going to get to that in just a few minutes. We did just have a really interesting conversation with Eric Clark, portfolio manager at Rational Dynamic Brands Fund. He joined us on our program, and he said that he wasn't ready to call a bottom, but he does think that the market has probably fully discounted the earnings recession that we've all expected, the earnings recession caused by raising rates. And at the same time, he caveated that with we could still see, 3,300 to 3,400 on the S&P 500, which would represent a significant decline from where we are right now, Katie.
He also said he's nibbling on Tesla, but that's another conversation. What I find remarkable when I look at today's action, 10-year Treasury yields just completely unchanged, less than 1 basis point higher, really captures at least my mood music. It's a holiday week.
When I look at the industry groups, it's actually showing that you have more advancers than decliners. 7 groups in the green, whereas only 4 are in the red. But the one that caught my attention was energy stocks, down 1.5% on the day. This is, of course, on concern that perhaps China is not going to pivot away from COVID-0. You have some news out of there that there are some deaths from COVID. There's also a rise in infections. Yeah. Everyone thinks that nothing's going to change over the winter, but certainly as you get towards 2023, people are looking for some kind of growth.
A 4-day work week here in the United States because of the Thanksgiving holiday on Thursday, and we should point out Friday, markets will close early. So most of the price action, most of the volume you're going to get at the beginning of this week. You put it all together, you get a Dow Jones Industrial Average lower on the day by about 0.1%. The S&P 500 lower by 0.4%, and the NASDAQ Composite down by about 1%. Meanwhile, the Russell 2000 really couldn't get out of the way, down about 0.6%. And if you're looking for any bright spots, believe it or not, Dow Transports closed higher on the day in the green. That's largely on the back of a lot of those trucking companies rallying.
Well, really speaking to the larger companies dragging on the S&P today, we actually had more companies move higher in the S&P, 271 advanced versus 232.
But was it the right companies, Jim?
Well, it's the big market cap companies like Tesla, Amazon, and Apple that really weighed on the index, so bringing it down.
Scarlett.
Okay, and of course, I mentioned earlier you had 11 industry groups and energy was leading the way down. I want to take a deeper look into what's going on here. Katie, you mentioned Tesla. That is definitely a factor here driving the S&P 500 Auto and Components Index off by 5.4%. All 5 members in that index are down, led by Tesla. And of course, energy down there as well, off by 1.4%. Oil prices at one point tumbled as much as 6%. But of course, then Saudi Arabia came out and denied reports that it is moving forward with any kind of production increase at next month's OPEC Plus meeting. A lot of time between now and then, of course, so there could be a lot more headline risk to be aware of. And on the upside, food, beverage, and tobacco companies up by 1.5%. There's that safety play once again in force. And real estate up by 0.7%. Insurance and utilities also higher by about 0.5%. Katie.
I'm going to talk about the story that we all know for my first gainer. We're talking about Disney. One Bob out. There's another Bob in. Chapek replaced by Iger. Romaine, I know you have thoughts here about whether that move makes sense, but Wall Street seems psyched. I mean, shares finished up over 6%. That gain was closer to 10% earlier, but still a big day for Disney. Let's also talk about Ross Stores, because had its biggest rally in 2 years on Friday. That's after reporting results. They were better than expected. They also boosted the full year profit forecast. That rally is carrying through to today's shares up 4.4% or so. I wanted to end on Domino's. I mean, like Scarlett walked us through, it's a good day for the defensive sort of sectors there. Domino's, the only piece of news I could find for today's action, they did invest in an EV fleet. They're going to roll out nationwide 800 Chevy Bolt EVs. I don't know if that's why the shares are up 2.7%, but that's a little bit fun.
I like that. I'll take it. All right, you got the gainers, Katie. I got the decliners. Let's talk about Apple. I mentioned these companies, big tech, mega cap tech, weighing on the S&P 500 today. Apple finishing down more than 2%. Scarlett, you alluded to the challenges that China is facing when it comes to potentially reopening and seeing more COVID cases, at least reported in recent days. That could be one of the reasons why we're seeing Apple underperform the NASDAQ 100 and S&P 500 today. Also at the bottom of the S&P 500 on a points and percentage basis, Tesla down 6.8% today. Shares down more than 26% from less than a month ago, October 28th, from when Elon's deal for Twitter closed. And then DraftKings finishing the day down by more than 5%. Biggest one-day drop since November 9th. The company moving lower after some customers reported that their accounts were compromised and money was withdrawn. The company did say that it had less than $300,000 of customer funds that were affected, and it intends to make whole any customer that was impacted.
Yeah, we should point out Tesla, fresh 52-week low. In fact, new low going back to 2020. New lows for Coinbase as well. You turn and look at what happened in the yield space. We were talking about this a little bit earlier. Only modest moves to be sure here, up about 2 basis points on your 2-year yield, down about 2 or 3 basis points on the other parts of the curve. You put it together, though, you actually end up with deeper inversion here. Right now, your 2s, 10s, somewhere around negative 73, 74 here. Remember, last week we were talking about a 2-10s curve that was at the steepest that we've seen in the negative going back to 1982. As of today, it's the lowest that we've seen going back to 1981.
I suppose that moves towards what Goldman Sachs strategists were looking for, which is lower valuations reflecting recession, a peak in interest rates. I mean, if you have a more deeply inverted yield curve, does that mean more of a recession than it signaled on Friday?
I remember when the curve first inverted a couple months ago, everyone told me, hold your horses. It's the depth of the inversion that matters. It's the length of the inversion.
Did they really say hold your horses? Or you just...
It's an expression.
Yeah. Okay.
Katie's partial to horses. So
I didn't even realize that I did that.
Yeah.
It was just so natural, very organic the way it came out. But now we're looking at a deeply inverted yield curve. It's been hanging around for a while. I feel like at this point, no one is really denying that signal anymore. Now it's just, I mean, where's the floor here? How deep could this go?
And I think, too, we talk about a lot of folks looking at sort of where that longer end of the curve goes relative to where the Fed's funds rate is. And that'll, I think, give you a better sense here of how we shake out with regards to recession predictions here. Meanwhile, we are getting some earnings, guys. Zoom Video crossing the wire right now. Their 3Q numbers coming in on an adjusted basis. The EPS at $1.07. That appears to be a beat. The street was looking for 83 cents a share. And the revenue numbers coming in at about $1.1 billion, which is pretty much on the nose of what the street was looking for. Here's your forecast, Scarlett. 4Q revenue, $1.1 to $1.11 billion, slightly less than the street estimate of $1.112 billion. And then for the full year on EPS, $3.91 to $3.94 a share. That's kind of in the range of what the street was looking for as well.
And this is something we'll talk about with John Butler of Bloomberg Intelligence a little bit later on. But the big issue for Zoom here is whether small businesses are willing to pay up for subscriptions, the enterprise market, because we know that consumers have Zoom accounts, but as long as we get off at 59 minutes, no one has to
59 minutes.
Yeah, no one has to pay the premium.
No one's paying the premium. And think about the growth story in the stock. You were talking about a stock, of course, during the pandemic was up. The revenue growth was something like a 100, 200%.
Astronomical. Yeah.
Now we're down into the single-digit percentage range for this growth story. So not necessarily a growth story.
It's a utility.
Yeah, and that's really how the company has shifted the conversation as we've moved to this next phase of the pandemic, moving away from the idea that this is a tool that's meant for bringing people together who aren't coming into the office and more one of hybrid work. Here's what the company's CEO and founder, Eric Yuan, said in a statement, quote, "Our customers are increasingly looking to Zoom to help them enable flexible work environments and empower authentic connections and collaboration, and they're working to proactively address these needs with expanding platform continues for Zoom in this environment."
It's not like anyone stopped using Zoom. It's just that they haven't really monetized it in the way that people thought they should. Is that the story?
That's part of the story, and I also think, what happens if you start to see some of these startups that aren't necessarily, growing at the rate that they were growing at before we started the most recent regime of interest rate hikes, right? If we look at how much money has been raised for startups this year versus last year, we're not seeing the small companies and medium-sized businesses grow to the same extent that they were growing at over the last couple of years.
Who else needs a Zoom account that hasn't gotten one already? That's my question.
Gus?
What's the total addressable market here?
Yeah, what about horses? Is there a market there, Katie?
That's true.
Yeah,
I don't know if they can
metaverse something
perceive screens,
No?
and I mean, they're...
I thought horses were smart.
They're actually incredibly smart and intuitive animals. That's true.
That's good. How long do they learn how to sort of put the hoof on the mute button so they're out there?
The whole thumbs conversation, it's really challenging.
Yeah.
All right, we got to run, guys, before this gets too out of hand. That is going to do it for our cross-platform coverage of the market close right here on Bloomberg TV. As you said earlier, she's taking a well-deserved day off. A reminder from today that Quick Take is now simulcasting on Bloomberg Business Week. You can do that at bloomberg.com/QT. This is Bloomberg.